COVID-19 and the Ukraine war rocked the world, and the oil prices. Oil prices have had a turbulent few years, dipping into the negatives when the pandemic started and rising to $140 per barrel in early 2022. What factors are presently affecting oil prices? How do oil prices affect us? And what does the future of oil and oil prices look like? Russia, according to the International Energy Agency, is the world's largest oil exporter to global markets. As a result, Russia's invasion of Ukraine and the ensuing sanctions against it have drastically disrupted the global supply of oil and driven prices up. When Russia first attacked Ukraine, already inflated oil prices jumped from $76 per barrel at the start of 2022 to $110 per barrel on the 4th of March. Despite sanctions against Russian oil, Russia's oil exports remain steady, albeit with a shift in the markets that it's now exporting to. Prior to the Ukraine war, which began on the 24th of February this year, 60% of Russia's oil exports were going to OECD Europe and 20% were going to China. As of October 2022, however, India and China accounted for 58% of all seaborne Russian crude exports, and Europe has since fallen head first into a severe energy crisis that is forecasted to continue into 2023. Western sanctions imposed with the intent to disrupt Russian oil production and reduce its ability to fund the war also had another unintended effect. The fall in access to Russian oil drove prices up, and Russia found alternate markets to sell its wares, resulting in even higher profits than what Russia was making before. And the value of its once depreciating currency went up significantly against the US dollar for the first time in many years. This isn't the first time that Russia's exhibited military aggression, and prompted world leaders to rethink energy security. Similar concerns arose when it invaded Georgia in 2008 and Crimea in 2014. However, the allure of cheap Russian energy proved too strong in the past, but this time might be different. With global temperatures rising, many Western countries have already made clean energy a sizable part of their long-term plans. While in the short run, most countries that are facing energy shortages because of Russia are looking for alternative supplies. This latest threat to their energy security has caused many to double down and target shorter timelines for their shift to clean energy, thereby reducing their energy dependence on external parties. On the 5th of October, OPEC Plus announced a reduction in oil production by 2 million barrels per day for purely economic reasons amidst rising inflation worldwide. This is significant. The world consumes approximately 100 million barrels of oil per day. A 2% reduction in the oil supply should technically drive up oil prices and inflation, as oil prices have spillover effects in many areas of life and industry. Despite this announcement by OPEC, however, oil prices continue to exhibit a downward trend, as they have over the last several months. As global economies are weakening, and the decision of OPEC Plus was in fact made in an attempt to help boost the price of oil in the face of declining demand. Expectations for China's gross domestic product, GDP, have halved, as the world's second-largest economy has struggled with stringent, and ill-fated, lockdown policies meant to sniff out all COVID cases. European nations are dealing with their own sky-high inflation, as well as a burgeoning energy crisis due to their reliance on Russian natural gas. The United States has suffered through 2 successive quarters of negative economic growth, and the Federal Reserve is determined to increase interest rates for as long as it takes to bring inflation down, which will ultimately cause the economy to weaken further. The price of oil is viewed through the lens of future global economic growth. Higher prices can signal investor belief that consumers will spend more, while falling prices demonstrate a conviction that demand will reduce. When COVID hit, most of the world responded by imposing complete lockdowns, and fear ran rampant as people read headlines that announced daily COVID-related death tolls. As offices, businesses and manufacturing facilities shut down and most people stopped leaving their homes unless absolutely necessary, the demand for oil plummeted. This meant that there was suddenly an excess supply of oil, and gas storage facilities and oil tankers began to fill up. Concerns around where to store the excess escalated, resulting in negative benchmark oil prices between 20 and the 22nd of April 2020. To match the decreased demand for oil, oil producers responded by decreasing production, and in some instances, curtailing it altogether. This created a new challenge as economies began to loosen restrictions and demand suddenly outstripped supply, leaving oil producers unable to keep up with rising demand, driving oil prices up as a result. While most people don't keep track of things like the stock market and the trajectory of global oil prices, whether we do it or not, oil prices affect all of us, directly and indirectly. Increased oil prices increase the cost of using private vehicles and public and private transportation services. This results in higher airline ticket prices and higher freight costs for the transportation of goods, among other things. As the cost of transporting goods from place to place increases, an increase in oil prices also drives inflation, in particular, for goods that are shipped over longer distances or overseas. Oil price increases also disrupt the market for fertilizer, and by extension, food, as fossil fuels are a major feedstock. One of the big casualties of the Russian invasion will be people who are already teetering on the edge in other places. It's not just Ukrainians. It's Yemenis, and Syrians and Nigerians. China's loosening of its zero-COVID policy is being seen as bullish for oil demand as Chinese demand had taken a hit due to lockdowns in early 2022. As of now, however, oil prices have been falling for the last several months and continue to fall further as global economies weaken and the demand for goods and services falls. The decision by OPEC Plus to reduce oil prices didn't have its intended effect, and in their last meeting on the 4th of December, participating countries decided to maintain oil production at its current levels, closely monitor markets and make decisions in response to market signals as they arise. While the insecurity that arose as a result of the Ukraine war is likely to expedite Europe's move away from fossil fuels, it could impede the transition in the rest of the world. Southeast Asia might turn to coal, while Russia, which accounted for 5% of global emissions in 2020, is unlikely to make progress on decarbonization in the absence of engagement from other key global players. In the much longer term, as most major global economies look to expedite the development of clean energy sources internally, the demand for crude oil is likely to fall. According to a statement released by the White House, with the passage of the Inflation Reduction Act, the U.S. is now poised to make the most significant investment ever in accelerating the clean energy transition, while increasing energy security, by increasing our reliance on American-made and American-produced clean energy and energy technologies.